reached record highs, and then they crashed in 2000. And it took them less than 7 years to reach record highs again, to trump their 1990s value. And then they crashed again in 2 years and crashed to pre-1997 levels. And now, lo and behold, they are again at record highs. What do you guys think is going to happen next?
Record.
Hopefully not record lows, but
That'd be pretty bad.
but there's a theory out there in finance called the real business cycle theory that says that every 10 years or so, that's what a business cycle is. You have a boom and a bust. So 2007 to 2009 was our last crisis. It was big enough to cover 2 crises, but yeah, so some people say we're due for one. The next crisis people are predicting are in student loans and or auto loans. But we'll see. No, it's okay.
Will that?
Anything interesting? No.
Will that lower the cost of dollars?
That's a good question. Let's think this one out. So if there's an auto loan crisis, I'm sure it would lower the cost of cars. It would definitely raise the cost of getting financing. But yeah, I mean, in principle, if there's less demand for cars, or less people can buy cars because financing is so expensive, then dealers are going to have to reduce prices. But Fabian, you say you work in cars, right?
Mm-hmm.
Maybe you can confirm or deny this. I almost got kicked out of the dealership that I bought my last car from. That's a fact. But because I was haggling with them, and they said that they're like already losing money on the transaction, and they said that a lot of the transactions they push, they actually lose money on just to get a client to do service work with. That's where they make their money now.
It's true on our side of the paperwork. However, there's a manufacturer side too. So like on our side of the paperwork, it shows that our dealership is losing 1,700.
Mm-hmm.
However, on the manufacturer side of it, when they're ordering shipments, the more we sell, the lower the cost. So
Okay.
altogether, we'll see exactly where it turns out, but from what we see negatives.
Okay. So on your balance sheets and your income statements, it's still going to be a loss, yeah. So.
And then you still have the financing transaction though. These
Yeah,
guys
but-
still make money on the finance.
Oh yeah, that is how they make a lot of their
Yeah.
money.
Paid from the banks, paid from.
Sam?
Since we're on that topic, so is it true that like if you own, say, a dealership and you sell Ford product, like cars, like the mission is to sell as many vehicles as you can, because if you meet the quota, Ford gives you back like a bonus or a kickback for.
They give you back a kickback, but at the same time, you also have more Ford vehicles out there, and if you're the only dealership around that area that can work on Fords efficiently, then most of the money in the dealerships are actually gained in the service department. So that's where the profitability of the dealerships really is.
So if you sell more, then you'll get even more that way, right? So you have.
That's the
extra
theory,
incentive
because
to-
most people that buy new cars typically tend to go to the dealer,
Yeah,
so.
makes sense. You got warranty on it, in case. Okay, so transitioning off cars real quick and back into finance.
Anybody want to buy a car?
So just real quick, can somebody give me a definition of a stock? We've sort of referenced it several times, but someone refresh my memory. What is a stock? Ownership. Yep. It's just a piece of paper that says you own an asset. And this piece of paper itself is an asset. Because what is an asset at the end of the day? Who knows? I've mentioned it a couple times, but it's got to come from your accounting classes. You guys have to have talked about this. An asset is anything that gives you value in the future. So anything where you're investing in something in hopes of it paying off at some point. And we're going to formally discuss the ways that it can pay off. So before we even get into stock markets, let's do a quick sort of talk aloud mental exercise here. You guys don't have to take notes, just help me talk through this, okay? So why does anybody pay anything? Pay money for anything?
Value.
Value, good. What about value?
If you don't see value, you won't buy anything. If you don't see value in the shoes you're wearing right now, in comfort or style or any of that sort, you won't even buy
Shoes
those.
have neither. But
Just saying, from Well, you see value in maybe the fact that horseshoes, economical,
Yeah.
whatever the case may be, but there's some type of value in anything. So
That's exactly it. So Fabian's hit the nail on the head. So the only reason that you would ever part with $1, which is basically the least common denominator for everything valuable, $1 can value everything valuable, bless you, is because whatever you're parting with that dollar for can also get you some value, okay? So there's two principal ways, there's two fundamental ways of obtaining value, okay? You've heard this distinction in all your economic classes. There is a service and there is a good, okay? What's the distinction between the two?
Good.
Jack?
Tangible and intangible.
So you can, it's tangible and intangible, I would argue is more of like a value. You can get tangible and intangible value from both of them. So I could get my shoes shined, and that's a service. And I would get the intangible value of feeling that, you know, I'm so rich that I can afford to get my shoes shined, and I'm so fancy. Or that also comes with tangible value is that, hey, my shoes are objectively shiny. The same can be said for any good that you purchase. So I can buy a new car, and if I buy a Ferrari, it doesn't ever have to leave my garage for me to get intangible value from it. I know that I'm a person who has a Ferrari. That boosts my ego. So that's intangible value. But there's also tangible value associated with the cars that I can drive and I can get places, right? Does that make sense? So that being said, what is the distinction between a good and a service?
Provided to you in a good object.
Yeah. So, well, yeah, that's a fair characterization. What I was thinking in my head, and this isn't a right or wrong answer, this is just us thinking out loud, but is that most of the value from a service takes place immediately, whereas most of the value from a good is spread out over periods of time. And I'm sure it's very easy to think of counterexamples of that. Of service as a haircut, for instance, and so I get value in my haircut, you know, for periods of time. But in general, if we were to offer one characterization of these two, that's my guess at it. If anyone's welcome to debate it if they want. So, but in finance, we deal with services. There are financial services, but that's not really what this class is about. This class is about valuing financial goods, and most of your classes will be about valuing financial goods. Services are what you guys will be performing once you understand goods. So, I propose to you that there are three ways that a good can add value. And from now on, I'm just going to call this good an asset, okay? So, you can get value out of an asset by using it, by holding it, or by selling it. Is that fair? Can anyone think of a different way that we can extract value out of our asset? Anything I missed? Renting it? So renting it out? That's fair. So first, can we rule out?
I guess you could understand.
Yeah, go on selling. But yeah, that's fair. We'll put it up there.
It's like halfway between selling and holding.
Yeah, somewhere here. Okay. So in this class, we're mainly dealing with financial assets. And I submit to you that it is very difficult to use a financial asset. Financial asset is a piece of paper. You can use it for fuel for a fire or for toilet paper, or you can't really use it in a very valuable sense. So most of the value from financial assets comes from these two, either holding it or selling it. And just for the heck of it, can somebody think of what value can come from holding a financial asset?
Appreciate it.
What's that?
You will appreciate it.
But okay, I'm very glad that you said that, even though I don't necessarily buy that answer. So think about this cup, okay? Let's say that you know one thing for sure, Jay, is that nobody will ever buy this cup from you. You own this cup right now, okay? So what's the difference to you if this cup is worth $1 million or $1 trillion or $700 billion or whatever? It doesn't matter how much it appreciates if you can't sell it. So that value appreciation comes from selling it. Does that make sense? The same is true. I gave you a non-financial good, but same is true with a financial good. So what about a financial asset? What about a financial asset? What value can come from holding a financial asset? We've dealt with mainly one type of financial asset this class. What were those assets? I heard
To
something.
write off your interest,
Bonds?
Bonds? Yeah.
tax
Returns.
incentives.
Let's start with Crystal. So what were you saying, Crystal?
Don't you get to, like, I have an asset, a house, I get to write off the portion of the interest I pay or taxes? or-
Okay, it's also very interesting that you said that, but the bond, there is a bond in that relationship, right? Who holds the bond? It's not called a bond, but it's something else. So you have a house, you have a mortgage, right?
Yeah.
I look better that way. But who holds the bond in that relationship? You or the bank?
What kind of bond?
What is a bond?
Yeah, you?
You own the
Wait,
you hold the bond.
no, like a house, if we're talking about a house?
We're
then-
talking about a house. So one party owns a house, one party owns no.
A
Neither party
mortgage?
owns anything. One party holds a house, one
Yeah.
party holds a piece of paper.
Yeah.
That house
yeah,
is called a house, the piece of paper is called a bond.
Yeah,
Right? So the bank holds the bond.
yeah,
So the real asset is in your hands, while the financial asset is in the bank's hands.
yeah.
Okay? So the interesting question for the purpose of this class is, what is the benefit of having the financial asset, of just holding a financial asset?
Interest.
Interest.
Interest earned.
Yes. Periodic payments. So you posed a very good benefit, the benefit of being the counterparty to that, holding the real asset and having a mortgage, and that's based on U.S. tax law.
And
That
that's not really, I don't know.
wasn't what I was looking for, but it is a benefit, and it's a very important one. And your entire corporate finance class, if you guys choose to take it, is going to be on that very benefit, or not entire, but I'd say at least 50% of it. So it's pretty important. But the benefit of holding a financial asset, what value you can get from holding a financial asset, purely comes in intermittent payments. So in the case of bonds, those intermittent payments are called coupon payments, interest payments. In the cases of loans, they're typically referred to as interest payments. But does anyone know what these intermittent payments are called in the case of stocks? Dividends. Yes. Okay, and we'll explore the important distinction between dividends and coupon payments momentarily. But got that out of the way. Okay, and second part of financial assets is pretty intuitive. How do you get value from selling it? Someone that I don't hear much from? That's definitely not you, Jay. No, I'm just kidding. All right, well, Jay said it. So yes, you have a capital gain. If it appreciates in price above what you paid for it, or more specifically, if we wanted to nitpick, above what you require to get back from it, then you get value. Okay? So with these ground rules in mind, let's examine the distinction between stocks and bonds. I'm going to erase this here. Okay, so on one hand we'll have bonds. Here we'll have stocks. So, neither one of these pieces of paper, both are pieces of paper at the end of the day, give you any value from using them. Any real value. Okay, so most of the value comes from holding or selling them, as we were talking about. Okay? Selling them makes enough sense for all of us. You're going to get value from selling a bond, you're going to get value from selling a stock if you sell it for more than you paid for it, or more specifically, more than you wanted for it back. Okay? But let's think about holding it momentarily. Okay? So what value do you get from holding a bond? So in the case of Crystal's banker, what value do they get by holding a bond? And let's make it more interesting. Let's think along the terms of real value or tangible value. Let's also just consider intangible value, even though that's a bit beyond the scope of this course. But let's start with intangible value from holding a bond. And I'll give you a hint. It was really important to finance our war effort. Does anyone know anything about that? And I mean our war effort, the World War II war effort. How did we finance World War II, we as in America?
Taxes.
Taxes, true. Tax rates were astronomical at the time. I think the richest people were getting taxed at like 96% or something. But I heard something else over here? War bonds, yes. So this is an intangible benefit. This is a tangible benefit to the government who's taking in money to fight wars, but it's an intangible benefit for us because we are doing something patriotic. You know, we are giving money in our government's hands to fight for what we believe in. So there's intangible benefits from holding bonds. So example, okay, what about stocks? Can there be intangible benefits to holding stocks? Can anyone think of one? I'll give you another hint, is not as big of a deal over here, but kind of a big deal in Europe. Taylor?
Just to be happy you own part of a company.
Yeah, sure. You're giving pub. There's a lot of research coming out, a lot of literature. Group.
If your currency fails?
If your currency fails, is that an intangible benefit or is that a tangible benefit?
I guess.
Because your dollars and cents are better off at that point. But if you think about, there's a whole stream of literature that's exploring this new type of investing called green investing. Is people investing in what they believe in. They're not necessarily buying the stocks that are most profitable, they're buying the stocks that are most important to them value-wise. This is not really a common way to think of investing in America. But in Europe, it's very common, Jay.
Are they becoming more popular here though? Like, I don't know what they're called, but they're like charitable corporations. But they're selling a product, but like giving a part of it to a charity. So
Yeah.
for the investor or the consumer, they're feeling like they're doing something good by investing in that.
Yeah, you're absolutely right. If you think about, I think Tom's, right? Tom's make shoes.
Right, yeah.
And I'm pretty sure they're a publicly held corporation. Anyone who challenges me, you're probably right. But as far as I know, they're a publicly held corporation. But why would an investor ever give money to that corporation knowing that if they didn't give half their profits to making shoes for kids who can't afford it, they would be making twice as much money, right? Why would you ever invest in a company that is only making half as much money as it could make?
You're a bad investor.
So the way we're taught to think of things, the way it was taught in my business school is that if a corporation's purpose is to maximize shareholder wealth, then yeah, they are truly being bad corporations and you're being a bad investor. But go ahead.
Since that's like non-profit or not-for-profit, wouldn't it be like a tax write-off and you wouldn't get taxed on that?
So yeah, you don't get taxed on those, so that's just, you're saving a tax benefit.
Yeah.
But you're losing more money than you're saving in tax benefit.
But I feel like in the case of Tom's, they're probably gonna make more, they probably do make more money by tacking on the charitable aspect to their
Yeah.
business.
How so?
Rather than, because, I mean, I've never worn the shoes, but I feel like if there wasn't a charitable aspect of that type of business, the shoe itself isn't, they're not appealing enough to like.
They don't give those shoes to
You buy, like, you buy
Nobody gets as much, yeah.
$2 pairs. It's not the same thing.
Okay.
They're not giving $100 pairs away.
Well, that's just because it doesn't. These shoes probably cost $2 to make. We're just buying them for $100.
Yeah, so it's still not the same thing.
Yeah, no, that makes perfect sense. But I think the bigger picture here is that investors can get some intangible benefit by owning a company, by knowing that you are financing somebody that is doing good in the world. If you're a person to whom doing good in the world matters, I'm not advocating it or saying you shouldn't, but Just saying, there could be intangible benefits to stocks, so. And more topical to this class.
What does
how
that
about
say? Owning company?
Owning company that's doing good in the world.
Okay.
Sorry. So, tangible benefit from holding bonds. Okay, so we talked about this. What is it? What actual physical monetary benefit? What's that?
Interest payment.
Yes, interest. So if you hold this piece of paper, you are entitled to interest payments. And only if you hold this piece of paper, you are entitled to interest payments. Why do they call them coupon payments? Because it used to be the case that this piece of paper had tiny little slivers at the end of it. Coupons that you tear off and present or mail in to the corporation, and they mail back the money. And that was great for people who didn't want to pay taxes, because nobody can track who actually owns the coupons. So since IRS figured that out, what the new rule is that every time you own a security, you have to register it with the IRS. So if you own a bond, you have to register it to avoid people just buying all the coupons and nobody knows, oh yeah, well, sure, I have the security, but I sold the coupons to Tom, and Tom sold them to Jan, and Jan sold them to Tim. Who can track down the coupons at the end of the day? So anyway, so you get these periodic coupon payments. So that's the tangible benefit of bonds. Okay. Tangible benefits to stocks we talked about are dividend payments. Okay. We didn't talk about the difference between the two, and it's an important difference. So without me talking about it, I don't know if any of you guys read or if you guys know from your other classes, what is the main, most important difference between a coupon payment and a dividend? Fabian?
Isn't that owed? And that one's somewhat like not promised, but you might get it, you might not.
Okay, I like your definition so far. Can Jay add to it?
Well, I mean, kind of what he said, there's no obligation to ever have to give a dividend by the company.
That's the word I was thinking.
Yep. Yes. So this is
Come to me while I'm stuff in my face.
obligated, and this is voluntary. And we'll talk about how this plays out on the income statement momentarily, but this is a very important difference between the two instruments, okay? There's also an important difference between the intangible benefits of the two instruments, okay? Common stock almost always, and in fact, by law, always in the United States, has some sort of voting rights attached, okay? So we cannot separate cash flow rights from voting rights in the United States in the case of stock. What does this mean? This means whenever you have to choose who represents you in the board of directors, you always have the right to vote. In practice, nearly nobody exercises that right. Only institutional investors and people who really care exercise that right. If any sort of merger or acquisition is going through, in most cases, it will come to a shareholder vote. You have this vote if you're a stockholder. You do not have this vote if you're a bondholder. So the company can materially alter their risk profile after you have lent them money as a bondholder without your consent. That is not the case for stockholders. So I don't know if that goes somewhere between tangible and tangible benefit, but typically voting people think of as intangible. It's not anything that can give you immediate money. So that's another very important distinction between stocks and bonds. Okay. And then the final distinction between these two instruments is their maturities. When you hold a bond, it's always for a fixed maturity. A bond, by definition, has to be for a fixed maturity. There have been cases where they've tried to get around that, and the legal venues have shut it down, so. And stocks are always infinite maturity. Okay? So we've talked about three of the, I'll argue, four very important distinctions between the two. And we'll see the next ones momentarily. Okay. Any questions so far? Okay. So, finally, talked about tangible earnings for holding. We know selling. For both of these, it's going to be the same thing. It's going to be whatever the sales price, right? That's going to be our tangible benefit. We're not even going to think about intangible benefits. Maybe there is, maybe there isn't. But the main benefit that we get from selling a security is very simply the money that we get from it. Okay? Clipping your nails?
I had a snag nail. If I don't clip it, I'm gonna end up biting my whole nail off
I'll
because
let
it's
you do
gonna
that.
bug me.
All right, I'm gonna erase this there.
Now you make me turn really red.
I'm sorry. Okay, so now we get to the fun stuff. How do you value these two securities? And this is a sneak preview that will be basically flesh most of it out, and then next class we'll go over the stuff in detail. But how do you value these securities? Well, we've determined that there are three primary sources of value: using, holding, and selling. And if I told you, what will you pay me for this piece of paper, you would have to, before answering, think about what value do I expect to get out of this piece of paper from using, holding, and selling, okay? And so, again, let's examine bonds. Stocks, okay? And let's start again with holding, okay? How do we value the benefits from holding a bond? Okay, well, there's going to be some cash flow associated with holding a bond. In fact, to emphasize this distinction, we'll call it a coupon payment. Okay? You're going to get this coupon payment at time T. Okay? To account for the fact that you're not getting the coupon payment now, but you're getting it at time T, you're going to have to discount this coupon payment by 1 plus this magic number R, which nobody really knows, and you're going to have to raise it to the Tth power. Okay? So, if you were just to get one coupon payment, this is how you would value it. But you get coupon payments every 6 months, or as otherwise specified. Do you guys know what this squiggly thing is? What is it? Sum. It's a summation. It's the Greek symbol sigma, and for some reason sigma stands for sum. So, from T equals 1 to capital T, where capital T is the maturity. So, from tomorrow, or from the next period to the period that this bond matures, you're going to be getting some coupon payment, and you're going to have to discount it, and that's going to give you the net present value of this stream of coupon payments if you just take the sum of these. Okay? Does that make sense so far? Is anyone confused by my notation? Okay. So, stocks, we have a analogous but interestingly different scenario. So we don't have coupon payments, we have dividend payments. But here's the magic question. what's the dividend payment gonna be for any company in the next period? Who can tell me? Nobody can tell me, because nobody knows. Because only the company knows, and even they don't know until the board of directors signs off on it. So, it's not the dividend payment, it's the expected dividend payment. Okay? And just a brief note, I'm going to put RD to denote the required rate of return on debt here. It's a minor distinction, but I don't want us to think that this R is the same as that R. We're going to do the same thing to this dividend payment. We're going to say 1 plus RE. This is the discount rate for equity. We're going to, again, raise it to whatever period we obtained this coupon payment from, or on, right? So if this is 3 years from now, we raise it to the 3th power, or whatever. If we're discounting semi-annually, we'd raise it to the 6th power. That's not exactly important right now. And again, we're going to take the summation. T equals 1 to what number goes here? From T equals 1 to when are we going to stop receiving these dividend payments? Infinity, right? But you can't really do anything in math with infinity. So what we're going to do instead is to say expected S, where expected S equals expected sales date. So you as an investor have an investment horizon. That investment horizon is, in any case, upward bounded for bonds. You can never hold a bond past its maturity. 2 other cases we need to think about: call or sorry, my writing's really sloppy here, but in the base case, we'll think about holding this bond to maturity, but it's also important to consider, as we talked about last class or 2 classes ago, the very realistic scenario of a bond getting called, in which case you wouldn't discount all these intermittent coupon payments till the maturity date, because you don't expect to hold on to it till the maturity date. You would discount it to the expected call date, because that's when you think you're going to stop getting these coupon payments. Or conversely, let's say you just need to invest your money for 6 months and take it out later, then you have an expected sales date of 6 months. And you wouldn't discount all of these coupon payments because you're not going to get all of them. You're just going to get one, the one between now and your sales date. So these are 2 sort of parenthetical cases that we can't rule out. But with stocks, it's much more complicated because neither of these 2 exist. There is no fixed maturity. If you keep holding on to the security, you'll have it forever. You'll get these dividend payments forever. But you don't live forever. As Keynes said, or Adam Smith said, or someone said, in the long run, everyone's dead. So you're going to value the security for as long as you expect to hold it. Okay? So without looking any further, and without really thinking about these numbers, because this is going to be what's going to be looked at further, can we tell which security is riskier and why? Jay's pointing over here. Raise your hand if you agree. 3, 4, 5, 6, 7. Raise your hand if you disagree. That's called schizophrenia, Jay. Okay. So, yes, and why, Jay? Why is this risky? Just by looking at it.
Yeah, just by looking at it.
Because expected sales is unknown.
Yes, because risk in finance is another word for volatility, is another word for uncertainty. Risk is uncertainty, okay? And just by looking at these 2 instruments, you have an uncertain dividend payment and an uncertain sales date. And here, I mean, unless you include these cases, in the base case at least, everything is certain. And so this uncertainty is definitionally risk. So stocks are riskier. Just from here alone, we can tell that, all things equal. But in fact, all things are not equal. And we'll get there next. I'll jump into something else first. So this is just valuing the intermittent payments. But we're also going to have to value the final payout. Okay? So I'll erase our little.
Can you not erase the one on the right?
Sure, I won't erase anything here. I'm just going to erase this part to give me room to write. Okay? So in addition to valuing these intermittent payments, we are also going to have to value the final payout. So we were looking at holding, selling. Okay? So again, in the base case, we sell for face value, and we sell it back to the company. We say, company, here's your piece of paper back, you buy it from us, and you give us $1,000. And this is known, and there's no uncertainty, and it's almost always going to be $1,000. Sam?
On the bonds, where you're talking about coupon is, T divided by 1 plus R. That T, so if it was like in 5 years, you would put 5 up there?
So here's the thing, this is
Or would
important.
it be
It's
10?
this summation. This T only matters because of the summation, okay? So we're summing for every possible T from 1 to capital T, where capital T is our maturity, okay? So if it was 5 years, in your case, there's going to be 10 of these things. There's going to be T equals 1, T equals 0.5, T equals 1, T equals 1.5, T equals 2, et cetera, et cetera. Does that make sense, Sam? Okay, so this summation means all of the T's. So if you were to write this out, and if I were to very meanly ask you how to do this, you would have to write out 20 of these guys. Coupon over 1 plus R.
So we're assuming that bond is for, in my case, like I said, 5 years, right?
Yes.
This is also assuming that it's a premium bond? Like, for example, for discount bonds, we don't give you.
Yes,
coupons?
there's no coupons for discount
Okay.
bonds. And I wouldn't make the distinction between a discount bond or a premium bond, because a discount bond is a thing, that it's a term that people use. There's no such thing as a premium bond. But it's theoretically impossible to have a bond that is a premium that doesn't pay coupon payments. But it's not that all bonds that pay coupon payments are sold at a premium. There's plenty of bonds that have coupon payments that are also sold at a discount, but they're not discount bonds. It's kind of confusing.
It's discounted because it's sold prior to maturity, right? And it's depending on the value or the interest rate fluctuation, right?
Yes, that second thing, I'm not sure about the first thing. The second thing that you said determines the discount. For instance,
Right.
consider the required rate of return on a bond is 10%, and it's paying you coupon payments of 7%. Nobody is going, even at issuance, nobody is going to pay the full value for that bond. That bond is going to sell at a discount. Not to be confused with a discount bond. A discount bond is one that by definition does not pay dividends, coupon payments. Sorry. Okay, is that distinction clear to everyone? Is there anyone to whom that distinction is not clear? Okay, because a discount bond is like an actual thing that has meaning. So we don't want to misuse that and confuse people. Okay, so if we're selling a bond, we sell it at the future value. Just going to put parenthetically $1,000. That's what it usually is per issue or per unit of the bond. And we're going to discount it by 1 plus RD to the T. Okay? Remember, this capital T was our maturity date. Okay, so I just want to take a second and stop and clarify. I see a lot of very diligent students taking down formulas, and that's very good because you might need them. But conceptually, does it make sense what we're doing? Because this is sort of what this class is structured on. We need to understand that why we're doing this stuff conceptually without the formula. So is there anybody, one second, Sam, I see, but is there anybody to whom these formulas don't make sense, or someone's confused why we're doing these formulas? Because the lines and numbers and Greek letters are all important, but the finance is what's around it.
You're gonna add those two together, aren't you?
Yes, I am. That should-
Yeah,
yep.
and that's what it comes down to.
Yes.
As far as
Mhm.
one plus that final.
Yep, and that's what your calculator does for you, but this is the mechanics behind it. So what we're really inefficient at doing relative to the calculator is this summation. Is this 20 or 10 coupon payments, and we have to value each one of them like this. We'd rather let a calculator do that for us. But real quick, just so everyone's on the same page, it makes sense why we're doing these two things separately, yes?
The bottom's the final payment.
Yes, it is, yep. And so, just a alternative case, if instead of holding this bond to maturity, we sold it before maturity because our kid has to go to college, we wouldn't do this face value, we do the sales price. Okay? But if we're valuing it now, we don't know what the sales price is going to be, so we do the expected sales price. Okay, just like our bond situation. If instead we were
Sir, but that'll change the T, won't it? The capital T.
yes, that will change the capital T. It's going to be when we expect to sell it.
Mhm.
So T equals 5 years. If we're holding this 10-year bond to 5 years, then 5 years, then it's going to be 10. Okay, so if it's a 5-year bond that Sam was working on, and we sell it halfway through, then we're going to raise it to T equals 2.5. Okay, and it's the expected sales price and the expectation taken today of the sales price at time 2.5. This is how we do it notationally. Don't worry about memorizing these formulas and all that stuff. Just make sure you understand what this means. Is that there's really 3 potentially relevant prices in the whole universe of bonds. But for the purposes of this class, unless it's like a call problem, worry about just the face value. That's what we've been worrying about till now, except for the example that I give you that's a callable bond, which I think is unknown. Okay, so
That's RD.
yes, the required rate of return on debt. Okay, you're going to be discounted at the same rate that you discount these coupon payments at. Sorry. Okay. For stocks, we don't have this FV to work with, so we're necessarily going to have to take an expectation at time 0 of the sales price at whenever we expect to sell this bond, stock, and we're going to have to discount it by 1 plus required rate of return on equity raised to the power of however many periods in advance we expect to sell this. Okay? This notation is not anything that you guys will find in textbooks or anything. I'm just trying to think of the most intuitive way for you guys to think about it. All right, so I want to make the distinction between this one and that one. But the concept is the same, okay? You're going to discount it by however many periods you're going to get that money. The problem is, in this case, it's certain however many periods you're going to get that money in. In this case, it's uncertain, so I use this expectation operator. And in this case, it's going to be your term, however long it is to maturity. In this case, you don't know. It's going to be whenever you sell it. Whenever you expect it, you'll have to sell it. Okay? But these notations aren't like standard textbook notations.
Are we gonna have to do that on the test?
No, but I'll tell you what you have to do, okay? So, you will have to do, this is almost a guarantee, because this is a very important thing. You will have to, as Ismail said, value a security, okay? If you're just interested in the test, I can tell you that there's 4 potential cases, okay? I could ask you to value a stock, where you don't have to worry about call dates or future values, okay? Or I could ask you to value a bond. If I ask you to value a bond, I could ask you to value it under 3 conditions. One, where you'd have to unload it at the future value as specified. One, where it's going to be called, and I'd obviously tell you the date at which it could be called. And the third, in which you'd have to sell it before you contractually do, or callable, or somewhere in between, but it's not called. Okay, but the point is, this formula is just here to tell you that you're going to have to discount it by the amount of periods that you'll get these cash flows in, okay? And so, as Ismail was saying, the true present value of either of these securities,
What was the first, thing you said on selling the value in the bond? You said call it, sell it before.
you tell me.
I didn't catch it. That's
I know, but think about it. What possible cases could there be in which you unwind a bond? So which did you already say?
I said, you said call,
Okay.
they're buying it, the company's buying it back, right?
The company's buying it back prematurely.
Right.
Okay.
And then you have, sell it before your contract's due because
Mhm.
you need to pay doctor bill or whatever.
Sure.
And then
If neither of those two things happen, what's the default?
when it's due,
Yeah, hold the bond maturity. Yep. So this is combining our knowledge of all three things that could possibly happen to a bond with this one exact computation. I could write this in such a way that it would be exactly one thing to represent all four of these. And that thing would be cash flow 1 plus R to the T, okay? So each particular cash flow, you'll have to value this way. Problem is, in a 5-year bond, there is 10 of these cash flows and one of those. In a stock that you hold on to for 5 years, you don't really know how many dividend payments. Realistically, companies that pay dividends, there's a huge penalty associated with cutting dividends or stopping dividend payments, omitting dividends. So it's reasonably predictable that if a company pays dividends, it's going to be paying that same dividend or slightly higher, and we'll get to valuing slightly higher momentarily. But in general, anything is possible. So it could be the case that you hold a stock for 5 years, you get a dividend in 6 months, you get a dividend in 3 years, and you get 2 dividends, in, I don't know, 4 years and 4.5 years or something. Right? So this is how you would deal with all of those scenarios. You would just have to keep in mind at one point you're getting the cash flow, and you would have to discount it by that same time. Okay? And it doesn't matter if we're dealing with dividends, coupons, face value, or what you sell it at. It's going to be this formula. The cash flow that you get, discounted by the appropriate rate at the appropriate time. Okay? So, if we wanted to compute the present value, what you would pay for either of these two securities today, it's going to be the sum of these two. The sum of the benefit from holding it, and the sum of the benefit from selling it. Make sense? No, it doesn't, because I said that wrong. It's going to be the sum of the benefit from holding it and the benefit from selling it. There's not two sums. Okay. All right. So this is all theoretical sort of pipe laying that we're doing right now. Next class, we're going to work out some examples of these. I want to give you some time to forget it first. And then, so let's jump into the wishy-washy social sciences side of this. I'm sorry, I should have asked. Did everyone get a chance to get all this down? Okay.
Can I ask a question?
Yep.
So would that be the same thing as the one period evaluation model, with PO equals DIP 1 over 1 plus KE plus P1 over 1 plus KE?
Okay, so that we'll be going over those specifically next class, but a one period valuation model is exactly 2 payments. You're in this, we're in stocks here. But a one period valuation model is 2 payments, okay? So it's the dividend that you receive in period 1, okay?
Mm-hmm.
Divided by 1 plus R, the discount rate that you use in one period, okay? Plus the sales price in period 1. This is a one period valuation model. You'll note it's the same formula. It's some cash flow divided by 1 plus some discount rate raised to some number. But in this case, we just have specific numbers. And if you're only holding it for one period, then the specific number in the exponent is always going to be 1. This rate is going to be the same. And here we have a dividend payment and the sales price. So we'll work out these examples next class, I promise. fact, I probably should have just done it this class, but I want to get through what stock markets are bull crap first. Okay. Oh, wait. There's one more interesting thing that I want to talk about. So, you need 2 minutes to run and get some water.
I told you bathroom break.
You guys need to take a bathroom break before
It's looking all bad.
Yeah.
Okay, so the first part, on the coupon T divided by 1 plus R to the T, that's basically the value of the bond at whatever time frame it is, correct? Then we're adding in the future value by saying this is what it was expected, with the present value of it, what it is in the future, and combining those two numbers to get the value of the bond today.
Yeah.
Really, that's what he's saying, right?
For the first cash flow, do the payment, you would do 1,000.
Okay.
Just discount the coupon payments and then.
Yeah,
and
to
then
whatever time frame you've held it.
Plus
If
the-
it's 10 years and you're up 5 years, then you've already been compensated for those 5 years, so we're just estimating the last 5 years. Plus what the future value of the $1,000 would be at time frame number 5.
30, so that's your first cash flow. And then you'd have to adjust your, the 1,000 for inflation.
So we don't need to, I mean, I understand what he's doing with the expected sell price, expected sales.
We got jump sheets
So
and
for your
stuff in
second
the
payment,
report.
you take 1,000 times 30 to get
I mean,
your
that's
second.
PhD level shit.
Cause it adjusts as it goes.
I watched that, I needed to
So
stand
you
that.
do that, I think it's your.
That was business finance.
I think it is.
That was business finance.
Aren't you taking that now?
Alright.
Okay, that's what I'm taking now.
Did he ever teach that?
Ah, that's why you remember it all, because you're taking it, yeah.
Right before this class.
Yeah.
See, I
I
wouldn't
don't
have guessed
remember,
it,
it's
but
been a
like,
while for me.
I get it now, but it's
I wanna forget that class.
I don't.
security, it's a regular security,
You
I
won't,
would just not know it.
I know.
Love it.
Everyone frustrated at the homework?
Yeah, some of the stuff we didn't go over, I was like, when in class did we?
Are you sure it wasn't the day that you missed?
No.
I
No,
don't
but
think
I
that was the day
asked,
we went over tips.
I asked.
Manager.
If we went over anything important, everybody said no.
You asked me? Oh. That's how it is, guys.
Well,
Hey, it is a finance.
Or
What
nonprofit
important thing
rescue
could we have gotten over?
animals. Or some kind of
Yeah, that'd be nice.
something.
So tips, okay, you went over tips.
Mhm.
Anything else?
It's the only thing.
I mean, this is a credible threat. I can give you the notes, but you'll have to read them yourself. Um, Or you can get the notes from someone else that are probably left.
Take picture of my notes.
Sure.
I will do.
Okay. So the other interesting.
You guys are getting open.
Okay, I didn't say anything.
The other interesting thing about the difference in risk between the two securities, stocks and bonds, I went over briefly before, I think more than once, but let me formally give it to you guys, okay? So, if you'll recall, at one point I said, even without looking further, we can tell that this side is riskier than that side because this side involved expectations. Expectations imply uncertainty, and uncertainty is defined as risk in finance, okay? Why else are stocks riskier than bonds? So can someone give me a heads up, maybe? Why else stocks might be riskier than bonds?
Other than what we, other than volatility, is that what you said?
Other than volatility, yes.
No, that's it.
Okay. Maybe that was the wrong question. I shouldn't say other than volatility because that volatility sort of includes this facet. So let's go.
They can lose value.
What's that?
They can lose value.
They can lose value.
I mean,
Let me ask this question. Have we used another term, a convoluted term, to describe stockholders. What other term do we use instead of stockholders, equity holders, and shareholders? They are the blank blanks.
Residual.
Yeah. Residual claimants. Perfect. You have earned yourself the right to tell us what that means.
You're last in line to receive your money.
Yeah, that's it. You didn't even need a marker.
I think that's like an extra credit star.
Yeah. All right. Fabian volunteered to give you some of his points for extra credit.
I did not volunteer my own points, I volunteered your points.
Ah, what makes you think I have extra points?
Cause you have homework, remember?
Now let's formalize what this means, okay? So when any company does business, it takes in money, all right? What do we call the money that the company takes in accounting?
Debt.
Did you say debt?
What does it say? They have a claim on all assets
Working capital.
Money.
and income left over after
All
claimants
right,
have
I've got
been
more now.
satisfied.
We call the money that the
Take that
company
star,
takes
revenue.
in
Take that
from
star.
business.
I got it.
Stockholders have a claim
You
on
said
all
revenue?
assets and
Oh,
income
okay.
left
You
over
said- yeah.
after
You
all
take that
claims
star.
have
You're just
been
demonstrating that you're
satisfied.
literate.
Nothing is left
Yeah.
over
We're all proud of you,
after
Jay.
As noted, however, it's possible.
Okay,
Even though he
so,
did say revenue, but
did you pronounce it wrong? You pronounced it French?
said revenue.
Okay, so revenue is what we call the amount of money that a firm collects from its operation, right?
That's not how you worded it, though.
You're right, you're right.
You said money that he took in after we were talking about residual claimants, that's why I
Right.
said debt, because it would be debt.
You're not dumb, I am saying, I
No,
heard
no,
your question.
no.
I apologize.
Miscommunication.
Okay, you did. What was it?
What is that, what Lewis said? What we have here, boys, is failure to communicate. Yeah, cool hand Luke.
What is it?
Cool hand Luke.
It's a
It's a
little-
movie in this, what is it, Lieutenant? or
Okay.
Sergeant?
Real quick though, we can get back to talking movies in 20 minutes, but what are we going to have? The first thing that we're going to have to subtract from the revenue is the actual, Sam?
Expenses.
Expenses, yes, expenses, but a particular subset of expenses. So you're not gonna subtract rent in this first step. Cost of goods sold, yes.
Dang, we going back to accounting.
Exactly. It all goes back to accounting. Accounting is the language of business, as I've heard it said, despite how much I fundamentally mistrust accounting. It's not going away. I'm going away before it does. Okay, so revenue minus cost of goods sold gives us our
Gross sales,
gross sales.
or gross revenue.
Gross profit.
Gross income.
I don't know. I thought it was gross profit.
Okay, gross
It would be
profit.
really bad if this was a loss, if it was a gross loss. But what's the next thing we're going to do? You got me, Taylor.
No.
Pi is a business I don't know, symbol for profit. Never actually know that. Okay, so what are we going to do to gross profit now that we have it?
I don't even wanna.
What's the
answer.
next thing? Okay, never mind. That's I'm setting you guys up for failure. All right, we're gonna subtract operating expenses. Okay, so this is our cost of goods sold, not to be confused with operating expenses. This is how much we pay the employees, what our rent is, what our utilities is, all that fun stuff. Okay,
That's pretty good.
that's gonna get us earnings before
EBIT.
almost
Taxes?
Interest.
interest and taxes. Yes, Jackson's got it.
EBITDA.
Depreciation, amortization. Okay, I'll let the accounting teachers explain to you guys about those things,
Is
but
that really gross pie?
gross profit, yeah, gross profit. Am I wrong there?
Oh, no, I just said no.
Profit in business is this is
That's where you threw me
the
off.
symbol for profit, anything business, so, sorry. I can write out profit, but sooner or later you guys are gonna have to get comfortable with this notation, because
Doesn't it have like a different little way the line is drawn in pie? I'm just asking.
Do you wanna draw stuff?
I just remember seeing.
Probably, yeah.
Pi and like one had like.
I'll tell you, doesn't it?
You've seen all my English letters, what makes you think I'd be better at Greek letters? Okay, so, EBITDA, okay, that's what this number is also called, all right? From EBITDA, we're gonna subtract depreciation and amortization, write it back in, we get EBIT. Earnings before interest and taxes, okay? What's the next step here? And this is a very important next step.
Add interest, I think.
Add interest. So where are we trying to go with this? What's our ultimate bottom line?
What's that, PA?
Sir? Depreciation and amortization.
Oh, subtract interest and tax,
Yes, which one do we do first?
would be interest.
Yes, okay. Minus interest. This right here is what corporate finance is about. There is an entire class dedicated to this, about subtracting interest before we get to taxes. This is the main benefit of debt. This is why debt is lucrative and advantageous, because any interest payments that you have on debt are non-taxable. Okay, so you get a tax shield on those. So let's say your interest payment is $5,000 for the year. The value lost from that interest payment, it's negative $5,000, is not going to be $5,000. It's going to be negative 5,000 times 1 minus gamma. Okay, which if your tax rate is 35%, if your tax rate is 25%, it depends, but it's going to be some number less than $5,000. Get rid of the negatives here. Okay, so this is what corporate finance is about, is how we can use taxes to, or how we can use interest to shield taxable income.
You said interest is non-taxable?
Interest expense is non-taxable because what we do to this EBIT before we get to paying taxes is take out interest expense. And that's going to be in stark contrast to something else that we'll talk about here. Okay? So, subtract out interest, then we get earnings before taxes, subtract out taxes, and we finally get our net income. Now, let's recall back to the example we started with when I asked Jay what he would pay for this cup that he could not sell for, or that he could not sell. Doesn't matter if that cup was worth $1 million or $3 million or $8 million or however much it's worth, if he can't sell it and the cup can't pay him anything, then this cup is worth 0 to him, or whatever the water inside it is worth. So, in order for the shareholders to find any value in the company, besides the value of selling, from here, we go to start at net income, we subtract out dividends. Okay? This is going to be the amount that goes to shareholders. And then we end up with additional retained earnings. All right. Don't worry too much about all that stuff, that's what you'll learn in accounting class, but you earn some amount of money in this period, after interest and taxes and everything. You're going to pay some of that out to your shareholders, or if you're a small business owner, you're going to pocket some of that, and you're going to invest the rest in the company. This is the rest, this is what you pay out to shareholders. Okay? The important thing to realize here, though, is that this is after tax. This is before tax. So your interest payments don't get taxed. Your dividend payments are after tax. Okay? And we pay this tax once at the corporate level. Does anyone here do taxes? Do their own taxes? Who does their own taxes? One? Just one? Nobody else does their own taxes? Two? All right, three. All right, there we go. Full participation. I did my own taxes yesterday, 2.5 grand back. You'll get, so you 3 people who do your taxes, do you invest anything? Do you have 401ks, IRAs, any of that stuff?
I used to, no, not anymore.
No.
Okay. Well, if you used to get a form called the 1099 DIV, 1099 dividend, okay? And what that means is you have to declare that you earned some money in dividends from these corporations that you partially own through stock. And what you have to do after you declare that money, after you declare that income, is you have to pay taxes on it again at the personal income tax rate. So that's why in corporate finance, we are very keen on the concept of double taxation. It's a major disadvantage of stocks, is because the income earned on stocks are going to be taxed once at the corporate level. That means from earnings before taxes to net income, we get taxes. So we have the sum of money, $1,000, and we have to pay out the $350 of it to Big Brother before we even get to collect any income. And then the board of directors distributes that income back to us as shareholders. Let's say they'll distribute half of it, so $325 goes back to us. And then we'll declare that income, and we'll have to pay taxes on it again, on our personal income taxes, okay? So double taxation in stocks. But this is sort of a side note. The main note is the main disadvantage of stock one of the main disadvantages of stock relative to bonds is that your money on stocks gets taxed and bond financing is non-tax. It's tax deductible. So you get to shield some of your profits. Okay? Stop here. Bless you. Again. Is anybody confused?
What was the meaning of RD?
Retained earnings. Sorry.
So you're saying on the bond level, you're only being taxed once because it's only on the interest?
So
what you're receiving is an interest payment?
There's two things going on here, all right? We can think of it from the investor side, and we can think of it from the company side. Bonds are advantageous to both, okay? From the company side, bonds are advantageous because this expense that they have on bonds, this expense that they have on a certain kind of financing, gets them the right to shield some of their income from taxes. If it weren't financed with bonds, if the company was straight stock finance, which you'll learn about in Finance 101, whatever Megan teaches, is there is no line here that says income, that says interest. EBT is that much bigger, and you have to pay that much more in taxes.
If it was funded with straight what?
Straight equity.
Okay.
Okay? So straight stock. So there's no interest here, and EBT is greater, and you have to pay more in taxes. You earn the same amount as a company, right? There's no difference. You sold 10,000 widgets to begin with for revenue, and you had fixed amount of cost of goods sold. You have the same profitability, same operating expenses. Difference is how you finance it. In one scenario, where you finance it in all stock, you have to pay more taxes. You get to keep less of your money. In another scenario, where you finance it with bonds, you can shield your interest expense. You can shield your interest expense from taxation. So you don't have to pay taxes on what you finance through equity, what you finance through debt.
On the corporate level, but the
Yes.
bondholder still pays.
Yes, the bondholder still pays taxes on the on his interest, right?
But that was only taxed once.
Yes, exactly, and that's the other important distinction is that you get double taxation as a stockholder, and you only get taxed once on your interest income as a bondholder. So it's going to depend on the tax rates, but just on surface, it sounds worse to get taxed twice. But yeah, so on the bondholder's perspective, if the compound effect of the if the amount of money you pay more in double taxes, the amount of money you pay in double taxes exceeds the amount of money you just pay on your bond interest income, then you're better off as an investor to invest in bonds and stocks. From the perspective of you have to pay less money in taxes on your income. Okay? So not doing a very good job at getting to these concepts that I didn't want to talk about, but that's okay. We'll get to as much as we can get to today and then skip the rest. Or follow up on the rest tomorrow. So, one of the first things we need to understand about stocks is that there are two kinds, okay? Does anyone know the two kinds of stocks? Two course categorizations.
Common stock.
This is
Common
common
and
and
preferred.
preferred.
Yes, common and preferred, yep.
Common has voting rights, preferred stock doesn't have voting rights.
Exactly. That is one of the main distinctions.
Another distinction that preferred get dividends paid first.
Yes, preferred do have priority over common. By the way, so what we demonstrated there with the income statement was exactly how the stockholders are the residual claimants, because you guys saw that the stockholders got paid out very last. These dividends were the very last. So the stockholders are the residual claimants. But anyway, so both preferred and common stockholders are residual claimants, but these guys are slightly less residual than those. So preferred gets before common stock. Okay.
What does that say? Dividends after PS?
After preferred stock dividends.
Oh, okay.
So these guys get dividends after the preferred stockholders get dividends.
Okay.
They get dividends before the common stockholders get dividends.
Couldn't you also trade your preferred stock to common stock? And there's a ratio for that?
I wouldn't be surprised if there were some securities designs
Yeah.
that allow that, but I've not heard that that's like a common thing for all preferred stock. Maybe it is. I'm not sure. So I'm gonna table that. I'll look it up. I know you can trade convertible bonds into common stock. Okay. Okay. And the other important distinction here is that preferred stocks have fixed level of dividends. They have variable dividends. Okay, so let's think about this. I'm gonna ask you guys to reason by analogy. We have a security here that has a fixed payment, that has no voting rights, and that has priority over common stockholders. This particular security is called preferred stock. Does it remind you of any other security? A bond. A bond also has no voting rights. Bond also has fixed payments, and a bond also has priority over common stockholders. What is the main drawback between, what is the main difference between this and a bond?
Your residual holder as a stock,
No
owner,
majority.
and as a bond holder, you're guaranteed your money up front.
Yeah. So these guys are also sort of, kind of-ish guaranteed their money, but not really.
At the end of the
Yeah, it's worse. So basically, the point I want to make is that preferred stock is a lot like bonds, except you don't, as a corporation issuing preferred stock, you don't get the benefit of tax deductibility. So why do this? Well, I can't give you the answer for that, but I can tell you that most people have caught on to that question. These are pretty rare security types, but they still exist. They represent a non-negligible portion of outstanding stock, but they're not a common new issuance. Very rare.
Sure, do the common stockholders, can they allow for more preferred stockholders as far as more shares being given out to preferred?
Can they what?
Okay, I know you can get more stocks here with common, as far as common stocks, you go to your shareholders, we wanna, issue out more stocks, so common stock shareholders say yes. What about preferred though? Do they also have the same kind of privilege to say that we want more preferred stock out there?
So in general, common stockholders don't like more common stock being issued because they get earnings per share of, let's say, $3. And if you issue 50% more shares, then if you distribute the new amount of earnings among 50% more people, then it's only earnings per share of $2. So common stockholders, current common stockholders, would shy away from encouraging the company to issue more common stock unless there's an abundance of profitable opportunities which that company just cannot access without more money, and they've exhausted their debt capacity or otherwise don't want to use debt. But common stockholders would much prefer to use debt unless they're worried about the risk of the company. If they're worried about, stability of the company, then they will prefer more common stock being issued, knowing all the full while that that's going to dilute their stake in earnings. So new issuance of seasoned equity offerings have with what's referred to as cash flow dilution to the stockholders. All right, we'll
Says
stop.
it costs more than preferred stocks, costs more to the firm, more than issuing debt.
Yeah, you can think, yeah, exactly, because you don't get the benefit of tax deductibility. So it's basically the same. I mean, it's all going to come down to the actual numbers that you plug in. You can plug in these guys fixed dividends of 1 penny per share, and it doesn't cost you nothing. But are they going to sign up for it? Are you going to sell yourself?
Less than 25% of new equity issues are preferred stock, and only about 5% of all capital is raised using preferred stock.
Yeah.
Where's the share park at? Parked in back?
So bonds is where it's at.
Yeah.
Said.
Bonds is where it's at.
Homework due Thursday?
Homework is due Thursday, unless you finish it today.